We're not really sure if it's a risk on, risk off trade in today's session. It seems that most are focusing on PMI numbers. We had great factory orders out of the US in yesterday's session as well, and it seems that earnings are also on the front foot at this point in time. How are you reading what is happening in today's session?
Yes, I think very good consumer numbers coming out of America as well, good earnings, a lot of M&A activity as well. So looking much more buoyant on the American side of things, and I think that is keeping our market relatively firm today. I think that there's a fight-off between a good American economy and people reinvesting in equities, and then the money from emerging markets flowing back onto the West and into America. So we've seen quite a choppy trade. When some of the foreign funds exit their positions, we see very big moves out of the stocks. We saw it in the retailers, a lot of retailers getting sold off 10-15%, and then slowly coming back again as people are more confident about the American market, and then starting to put money on a local front. So there's a bit of a fight-off between emerging market, foreign money coming out of emerging markets, and a slightly more buoyant American market.
That's quite interesting. I mean, obviously we're starting, as you alluded to see the foreigners start liquidating their positions in most emerging markets. Tell us about the role that the Egyptian crisis has to do with the fact that we're starting to see funds being flowing out of South Africa, and keeping in mind that the bond market in South Africa has been experiencing bond outflows since the end of last year. So perhaps it's a combination of factors.
Yes, it is a combination of factors. I think what Egypt has brought to the fore is that political risk is something that is far greater in emerging markets than it is in the Western economy, and people are worried about that political risk. So they're taking a little bit of money. They made a lot of money in the last year and a half in emerging markets, and they're trying to bank some profits. So it's not necessarily that they're exiting emerging markets as a whole, but they definitely are banking some profits. So we'll have to see, once they've taken some of these large profits, and in dollar terms profits as well, that they made over the last year and a half, will they just rebalance their portfolios, or they're exiting totally? And I think it's more of a rebalancing, and I think we'll start to see the emerging markets still come back in the middle of the year and be very strong again.
You're talking about some companies experiencing high volumes, and also as a result of this, we're seeing some money being taken off the table. Pick n Pay has been on the forefront of the losses over the last couple of sessions. Yesterday, down around 3.5%. Tell us about the volumes that this counter has been experiencing.
Yes, well, on average, I think it's been trading about 2 million shares on average a day, maybe a little bit less. In the last few trading sessions, we saw up to about 4.5 million trade in Pick n Pay. So there's definitely some big volume going through there, and it's volume that's pushing the price down, which is relatively negative for Pick n Pay. Probably another foreign or another fund taking some money off the table on South African retailers. It has underperformed all other retailers over last year, Pick n Pay. There's also contrarian views that maybe it will start to outperform some of the other local food suppliers like Shoprite. But the volumes have been very high, a lot of activity in Pick n Pay. We're watching that closely over the next few days to see once that big volume settles down, which way the share will move. But currently quite negative for most of the retailers in South Africa as people pull out money and take profits.
Another sector that is experiencing losses over the last couple of sessions is the construction industry. Money also taken off the table there. Marion Roberts losing over 20% in the last two sessions after it warned that earnings could be down by as much as 45%. Rob, are we going to see this throughout the construction space at this point? We also had Aveng warning that headline earnings per share could drop by as much as 20%.
Yes, construction companies are under a lot of pressure. There's not as much business coming through. Their order books are much smaller. They're battling to get paid, in Marion Roberts' case, from their foreign developments. Just moving away, we also see that in Dubai, the Tiger Woods, very big development going on in Dubai, has been put on hold. So you can see that in the Dubai section, that property sector still hasn't recovered yet. And on a local front, a lot of the big spending from the World Cup is now finished. And again, we saw earlier in your report that the housing numbers are still relatively weak, and pricing for housing looks like it's starting to drop again. So a very difficult time for the construction sector. Some of those PEs have come in below 5 now with these new prices after they've come down 15-20%. And you start to look at when do you start buying these construction stocks again. I think it's something to look at in the next month or two, maybe 3 months going forward, to see when do you start putting that trade back on. But currently, it's not a rush to get in there. I think they're under a lot of pressure, and we'll have to have a really big push in local spending for that construction sector to get back on track.
Rob, some would argue that yes, we're sitting at PEs of around 5 to 6 when it comes to the construction space at this point, but others would say it is a value trap, because every time we see earnings coming to the fore, they are just disappointing one quarter after the next.
Definitely, I think that you do want to put on a trade slightly earlier on, and you want to try to get ahead of everybody else and put the money on very early in the trade. But I think in terms of the construction stocks, you've probably got a month or two still to wait and see if that economy starts to turn around. You probably wouldn't be putting in new money into the construction right away. Wait 2-3 months, otherwise you're going to get caught in that value trap where you just sit in a position, don't necessarily lose money, but over the 6-7 months it hasn't really do anything on the upside. You could have used that money better somewhere else.
Touching on Merafe Resources, looking at capacity utilization, sitting at 74% in 2010, and that's from 50% in 2009, a significant increase there. The company says that margins remain under pressure because of the current exchange rate, but we're starting to see a slightly softer rand as well.
Yeah, it's looking relatively good for Merafe. I mean, they had shut down some of their some parts of their mines, etc., and they had switched those back on last year. So coming from a very low base, I think the only capital utilization was about 40-50% last year. They've moved it up to about 74%. So looking very good on Merafe's side. We have to see if China increases the interest rates and can they get that economy slowing down. If they don't, I think that they're going to still be using a lot of steel and ferrochrome going into China will still be very good. So I think they're looking very strong, Merafe, at the moment, and it's something to look at going forward.
Fantastic, Rob. Thank you so much for joining me today.